Welcome back to LyraPulse, the podcast where we decode how global events shape financial systems and business strategy. I'm your host Bhakti, and today we're diving into one of the most consequential geopolitical events of our time, the Russia-Ukraine conflict, and how it transformed global markets. Joining me today is Dhananjay, a senior strategy consultant with over 7 years of experience advising Fortune 500 firms on geopolitical risk and market strategy. Dhananjay, welcome back to LyraPulse.
Great to be here, Bhakti. It's a heavy topic, but incredibly important. This conflict has fundamentally changed how markets respond to geopolitics.
Let's start at the beginning. Late 2021 into early 2022. What were the markets sensing back then?
Well, by late 2021, we was a slow building shock. Satellite images and intelligence leaks were showing Russia troops build upon on Ukraine border. Markets had uncertainty, and this was a textbook geopolitical risk. Energy prices creeping up, European stocks showing early volatility, and investors moving cautiously.
So it wasn't a shock when the invasion happened.
The scale of it was on February 24, 2022, when Russia launched a full-scale invasion. Global equity market reacted violently. European market tanked, and even US saw sharp declines. It was a synchronized sell-off, the kind you usually see when the global financial crisis happens.
Dhananjay, walk us through those first few weeks post invasion. What were the dominant market reactions?
Well, the reactions were seen in three major channels. First, equities, especially firms with Russia ties or exposure to European demand, dropped sharply. Commodities exploded. Brent crude shot about $130 per barrel. Natural gas and wheat prices soared. Nickel even had to halt trading due to extreme volatility. Third part was currencies. The Russian ruble collapsed, while gold and the US dollar became safe havens.
And then came the sanctions, right?
Exactly. The West hit Russia with the most aggressive financial sanctions since the Cold War. Russia banks were cut off from SWIFT, oligarchs' assets were frozen, and trade restrictions mounted. This created a whole new layer of financial stress and risk contagion.
So, how did the market start adjusting through mid 2022?
We entered a phase of volatility and divergence. European indices, especially German DAX, remained under pressure. On the flip side, energy companies and defense contractors rallied. Banks with Russia exposure, especially in Austria, France, and Italy, underperformed significantly. We also saw deterioration in corporate and sovereign credit market, particularly in Europe and the emerging economies like Turkey and South Africa.
Was the market response more than just a regional?
Oh, absolutely. The war increased interconnectedness. For example, volatility in European energy markets spilled into emerging markets like India and Brazil. These economies became unexpected risk transmitters because of their role in global trade and energy flows.
What changed in 2023? The war didn't end, but markets seemed to calm somewhat.
Yeah, the war was not end. We hit what I called a conflict stalemate, market adaptation phase. Equity marketers volatility dropped compared to 2022, but currency and commodity marketers took center stage. Gas prices were still volatile, but stock traders started pricing in prolonged war. The focus shifted to inflation, interest rate, and energy security. German manufacturers and utilities remained under stress due to gas dependence.
So, while the panic phase was over, the damage wasn't.
Exactly. And there were long term consequences unfolding, supply chain realigning, investment flow changing, and companies starting to exit or reprice risk in Europe.
Now, in 2024 and 2025, the conflict is still active. Ukraine has even launched limited cross border incursions. How are markets reacting today?
The keyword is endurance. Markets have adapted, but they remain sensitive. When Ukraine launched its Kursk incursion in 2024, it triggered brief volatility in energy market, but nothing like 2022.
So, what's different?
Risk transmission has evolved. We are seeing fewer equity stocks and more sensitivity in energy and currency market. European markets, especially German and Eastern Europe, continue to underperform due to energy mix and export dependency. Meanwhile, Asian and US markets have shown more resilience thanks to lower direct exposure.
Now, let's zoom out. What are the three biggest market lessons from this conflict?
Great question, Bhakti. Let me tell you in three steps. The first, geopolitical risk, is abstract. It's real, immediate, and deeply market moving. Secondly, the world is more interconnected than many assume. A gas pipeline disruption in Ukraine can shake up stocks in Sao Paulo or currency market in Jakarta. Thirdly, the conflict has accelerated long-term trade, energy diversification, reshoring of supply chain, and greater use of commodities and forex as risk indicators.
So, what should investors and companies be watching going forward?
I'll just say stay alert to job political risk pricing, especially in sectors like energy, defense, and commodities. Watch for shifts in capital flow. They are in growing tilt towards geopolitical safe havens. And finally, track structural shifts, energy partnerships, defense budgets, and even food security deals. These are new fundamentals.
Dhananjay, this has been a fascinating deep dive. Thanks for helping us connect the dots between geopolitics and market dynamics.
Always a pleasure, Bhakti. Stay safe and stay strategic.
That wraps up today's episode of LyraPulse. If you found this conversation helpful, don't forget to subscribe and share. And as always, stay curious.